Welcome to the Retirement Wealth Podcast. We're so glad you're joining us today.
Yeah, it's great to have you here. We've got an interesting topic lined up, don't we, Emily?
Absolutely, David. So today we're diving into the world of investing for retirement, and specifically the age-old debate of growth versus income investing.
Right, and it's such a crucial decision for anyone in or nearing retirement. Do you focus on growing your nest egg, or do you prioritize generating income from your investments?
Exactly. It can be really overwhelming, especially with so many options out there. So we're going to break it down for you today.
We'll explore the pros and cons of each approach, how they fit into different retirement lifestyles, and what you should consider based on your personal goals.
And of course, we'll share some practical tips on how to balance growth and income in your retirement portfolio.
Plus, we'll touch on some common misconceptions that can trip people up when making these decisions.
So, whether you're just starting to think about your retirement strategy or you're already in the thick of it, we've got insights that can really help.
Let's get into it then.
Sounds good. So let's start by defining what we mean by growth investing versus income investing.
So, Emily, when we think about why growth versus income investing matters right now, it's really about the landscape we're navigating, right? The market's been volatile lately, and many people are feeling that pressure.
Absolutely, David. I mean, with inflation rates fluctuating, it's become even more crucial to ensure that your retirement savings are growing at a pace that can keep up. I've heard from some listeners who are worried their savings might lose purchasing power if they're not strategically invested.
Yeah, and that's a valid concern, you know. Take someone like Linda, for example. She's in her early 60s, planning to retire in just a few years. She initially thought her savings would be enough, but with inflation creeping up, she's realizing she needs more growth to maintain her lifestyle.
Right, and it's not just about the numbers on a spreadsheet, is it? It's about the emotional side, too. I mean, Linda is feeling a lot of anxiety about whether her money will last. That uncertainty can really weigh on someone as they approach retirement.
Exactly. And then there's the impact of market volatility. It can make anyone second-guess their investment strategy. I had a client, Tom, who was heavily invested in stocks, and when the market took a dip, he felt like his entire retirement was at risk.
I can imagine how stressful that must have been for him. It's hard to watch your hard-earned savings fluctuate like that.
It is, and that's where a balanced approach can really come into play. It's not just about growth or income. It's about finding that sweet spot that allows you to weather the storms and still have a reliable income stream.
And with Social Security changes on the horizon, it's another layer of complexity, isn't it? Some people are unsure about how those changes might affect their benefits and overall retirement income.
Absolutely. Many folks are counting on Social Security as a cornerstone of their retirement plan, but it's essential to understand how those benefits might evolve. I mean, if you're planning to rely on that income, you need to have a strategy that accounts for potential changes.
That's a great point, David, and let's not forget about healthcare costs, which are skyrocketing. Many retirees are shocked at how much they need to budget for medical expenses in retirement.
Right. Just think about Susan, a retiree I worked with. She thought her savings would be enough, but after factoring in her healthcare costs, she realized she was falling short. It's crucial to have a plan that takes those rising expenses into account.
So it sounds like what we're really talking about here is a holistic approach to retirement planning. One that considers growth, income, inflation, and all those other factors.
Exactly. And, legacy planning is another piece of this puzzle. Many retirees want to leave something behind for their loved ones, whether that's financial support or something more tangible.
Right, and if you're not careful with your investments, you could end up sacrificing your own needs in order to leave a legacy. It's all about balance.
And that's what we're seeing in the current economic trends, too. With interest rates rising, traditional income investments like bonds aren't yielding what they used to. This pushes people to look for growth opportunities to help offset those lower returns.
Yeah, it's like a domino effect. You think you have a solid plan, but then you have to rethink everything because of external changes.
Exactly. And it's easy to get overwhelmed. But this is why having a solid strategy can bring peace of mind. When you know you have a plan that addresses each of these concerns, it's a lot easier to feel secure.
And that emotional security is so important. I mean, retirement should be a time of enjoyment, not constant worry about finances.
Right. It's about enjoying those years, traveling, spending time with family, and not being stressed about how the market is performing or whether your savings are sufficient.
So as we transition into discussing core strategies, I think it's clear that a one-size-fits-all approach doesn't work anymore. It's about customizing your investment strategy based on your personal goals and the current economic landscape.
Yes, and understanding that the balance between growth and income is not static. It can shift as your needs change and as market conditions evolve. It's a dynamic process that requires ongoing attention.
And that's something we'll definitely dive into next. How to navigate this balance effectively for a truly secure retirement.
So, Emily, when we're talking about growth versus income investing for retirement, it really boils down to understanding what your goals are, right?
Exactly. And I think a good place to start is with your risk tolerance. If someone's more risk averse, they might lean towards income-generating investments like bonds or dividend stocks.
Absolutely. Bonds are typically seen as safer than stocks. For instance, if you have a portfolio that's, say, 70% bonds and 30% stocks, it can provide more stability, especially as you get closer to retirement age.
Right, and then there are those dividend-paying stocks too. They can provide both growth and income. It's like a 2-for-1 deal.
Exactly, and when we look at withdrawal strategies, the 4% rule often comes up. It suggests that if you withdraw 4% of your retirement savings each year, you can maintain your lifestyle for about 30 years without running out of money.
Yeah, but it's important to note that the 4% rule is a general guideline. It doesn't guarantee success in every market condition, especially with inflation and market volatility.
Good point. That's why having a diversified portfolio is crucial. You want to mix different asset classes, stocks, bonds, maybe even real estate.
Real estate can be a fantastic way to generate passive income, right? Like, if someone owns rental properties, they can create a steady cash flow while also benefiting from property appreciation over time.
Exactly. And speaking of cash flow, let's not forget about tax-advantaged accounts like 401k and IRAs. They can significantly impact your retirement strategy.
Oh, for sure. With a traditional 401k, you're putting pre-tax dollars in, which lowers your taxable income now, but you'll pay taxes on withdrawals later.
And then there's the Roth 401k, where you contribute post-tax dollars, and your withdrawals in retirement are tax-free. It can be a game changer for tax planning.
Definitely. And for those who have both types of accounts, it can allow for more flexibility in withdrawals and tax management during retirement.
Right. And then you have to consider required minimum distributions, or RMDs, which kick in at age 73. If you don't plan for those, they can really impact your tax situation.
Yeah, RMDs can push you into a higher tax bracket if you're not careful. That's why it's so important to have a withdrawal strategy in place.
Speaking of strategies, the bucket strategy is another method worth discussing. It involves segmenting your investments into different buckets for short-term and long-term needs.
I love that approach. You could have a bucket for immediate needs, like cash or short-term bonds, and another bucket for long-term growth, like stocks.
Exactly. And that way, you're not forced to sell your long-term investments during a market downturn just to meet your cash flow needs.
And it helps reduce the emotional stress of worrying about market fluctuations. If you know you have a secure cash flow for several years, it can be a huge relief.
Definitely. And let's not forget about Social Security optimization as part of the overall strategy. Deciding when to start claiming benefits can really impact your financial landscape.
For sure. If you delay claiming Social Security until age 70, your benefits can increase significantly. It's like an 8% increase for each year you wait past your full retirement age.
Yes, and for some people, that might mean waiting if they can afford to. It's all about balancing your needs with what you expect your longevity to be.
Right. Some folks might need to claim earlier due to health concerns or financial necessity, but it's a good idea to weigh all options.
And when we talk about asset allocation, there's no one-size-fits-all. You might see recommendations like a 60-40 portfolio, 60% stocks and 40% bonds, but that really depends on individual circumstances.
Exactly, and life changes can affect your allocation too. If you retire early or have unexpected expenses, you might need to reassess your strategy.
And let's touch on tax savings techniques. For example, tax loss harvesting can be a great way to offset capital gains with losses.
Such a valuable strategy. If you have investments that are down, you can sell them, realize the loss, and use it to offset gains elsewhere.
Right, and it's important to remember that you can't just buy the same security back immediately, or you'll trigger the wash sale rule.
Yes, that's a good point. And diversifying across different asset classes can also help manage tax implications. Keep that tax burden spread out.
And, sometimes people might overlook annuities as part of their retirement strategy. They can provide guaranteed income, which is appealing for those looking for stability.
That's true, but it's essential to understand the fees and terms associated with annuities. They can be complex, and not all are created equal.
Exactly. It's all about finding the right balance for your personal situation. And as we've mentioned, keeping an eye on your overall asset allocation and adjusting it as needed is key.
And I think that leads us nicely into discussing common pitfalls. Because even with all these strategies in place, there are still things people can overlook or get wrong in their retirement planning.
Yes, and that's where many folks can trip up. So, Emily, when we talk about retirement planning, one of the biggest pitfalls I see is what we call sequence of returns risk.
Oh, absolutely. That's a big one. Can you explain a bit more about what that means for our listeners?
Sure. Basically, it refers to the risk of receiving lower or negative investment returns early in retirement while you're withdrawing funds. If the market takes a downturn right when you start drawing from your investments, it can really impact your portfolio in the long run.
Right. Because if you're selling assets at a loss...
Exactly. You're locking in those losses, and it can significantly shorten the life of your retirement savings.
I think a lot of people don't realize how much that can affect them. Do you have any real-life examples?
Yeah, I can think of a couple. There was a retired couple. Let's call them Jim and Linda. They retired in 2007, right before the financial crisis hit. They had a solid nest egg. But with the market crashing shortly after they retired, they were forced to pull money out at a time when their investments were down.
That must have been so stressful for them.
It really was. They ended up withdrawing funds to cover their living expenses, and it left them with much less to work with when the market rebounded. They had to adjust their lifestyle dramatically, which is never easy.
I can only imagine. So what could they have done differently?
Well, if they had a more diversified withdrawal strategy, perhaps keeping enough cash reserves to cover a few years of expenses would have helped. That way, they wouldn't have to sell off their investments during a downturn.
That makes so much sense. Another common mistake I see is people ignoring taxes when planning their withdrawals.
Yes, that's a huge oversight. Many retirees focus solely on their gross income without considering the tax implications.
Exactly. I remember speaking with a woman named Susan who was excited about her retirement income plan. She had a good amount saved in tax-deferred accounts, but hadn't thought about how much she'd actually take home after taxes.
Right, and that can really change the game for someone's budget. She was in for a surprise when she realized her withdrawals were pushing her into a higher tax bracket.
Ouch. So how can people avoid that surprise?
It's all about planning. You should evaluate your tax situation year by year and consider a mix of tax-deferred and tax-free accounts for withdrawals. Having a tax-efficient withdrawal strategy can really help maximize your retirement income.
That's such good advice. Now, what about healthcare costs?
Oh, healthcare is another area where people often underestimate their needs.
Right, and with rising healthcare costs, it can really take a toll on a retiree's budget.
Exactly. I had a client, let's call him Mike. He thought he had enough saved for retirement, but he didn't account for the increasing costs of healthcare.
Did he have any specific health issues?
No, he was relatively healthy, but he just didn't factor in things like long-term care or even the rising cost of premiums. By the time he realized it, he was already in retirement and had to make some tough adjustments.
That sounds really tough. So what should people consider to avoid this pitfall?
It's important to do a thorough assessment of potential healthcare needs. Planning for long-term care insurance or setting aside a specific amount for medical expenses can be a game changer.
Definitely. And then there's the issue of longevity.
Yes, many people underestimate how long they might live. With advances in healthcare, people are living longer, which means your retirement savings need to stretch further.
I've heard stories of people running out of money in their late 70s or early 80s because they didn't account for that longevity risk.
Exactly. There was this couple, let's call them Sarah and Tom. They planned for a 20-year retirement but ended up living into their 90s. Their savings dwindled much faster than they anticipated.
That must have been quite a shock.
It was. They had to make some drastic changes to their lifestyle, which can be really difficult at that age.
So what's the takeaway for listeners regarding longevity?
It's wise to plan for at least 30 years in retirement. It might feel like a stretch, but having a plan that accounts for a longer lifespan can really help you avoid running out of money.
And then there's asset allocation. That can really make or break a retirement plan, right?
Absolutely. A lot of retirees tend to become too conservative too quickly in their asset allocation.
Yeah, they think they should be more cautious as they age, but that can actually backfire.
Exactly. A retired couple, let's call them Karen and Steve, decided to move almost all their money into bonds as soon as they retired. They were too worried about market volatility.
And that's understandable. But what happened?
Well, with inflation and low bond yields, their purchasing power started to decline. They weren't growing their assets enough to keep up with rising costs.
So what's a better strategy?
It's about finding the right balance. A mix of growth and income investments can help protect against inflation while still allowing for some stability.
Great advice. And lastly, what about Social Security?
Claiming Social Security too early is another common mistake I see.
Right. I've heard people think they need to claim it as soon as they can, but that can reduce their benefits significantly.
Exactly. There was a client, let's call him Frank, who claimed at 62 because he wanted the money right away. He didn't realize that by waiting until 70, he could have boosted his monthly benefit significantly.
That's a tough lesson to learn.
It really is. The longer you wait, the more you can receive. It's important to evaluate your situation, consider your health and financial needs, and plan accordingly.
So it sounds like the key here is doing thorough planning and being aware of these common pitfalls.
Absolutely. If you can spot these red flags early, you can adjust your strategy before it's too late.
And for those who may have fallen into one of these traps, what are some next steps they can take?
Well, the first step is to reassess your current plan. Take a good look at your withdrawal strategy, tax implications, healthcare costs, and your asset allocation.
And maybe consult with a financial advisor to help navigate these decisions?
Exactly. Having a professional can really make a difference in creating a solid retirement plan that can adapt to changes in market conditions and personal circumstances.
Wonderful insights, David. I think our listeners will really appreciate these tips.
I hope so, Emily. It's all about being proactive and making informed decisions to enjoy a worry-free retirement. So, Emily, as we dive into the next steps, it's really about taking some actionable steps that people can start implementing right now, right?
Absolutely, David. It's all about making those small changes that can lead to big impacts over time. Where do you think someone should start?
Well, one of the simplest things you can do is to review your current investment portfolio. Like, really look at what you have and see if it aligns with your retirement goals. Maybe set a reminder to do this quarterly, just to keep things fresh and relevant.
That's a good idea. And while they're at it, they could run some retirement projections, right? There are some great tools out there.
Exactly. Websites like Vanguard, Fidelity, and Schwab all have retirement calculators that are free to use. They allow you to input your current savings, expected retirement age, and lifestyle choices to see how your plan stacks up.
And I love how user-friendly those tools are. Plus, they give you a pretty clear picture of whether you need to adjust your savings or maybe rethink your investment strategy.
Right. And don't forget about Social Security. Checking out ssa.gov can help you understand your benefits and when might be the best time to start taking them. It's such a crucial part of retirement planning.
For sure. And speaking of planning, what about tax software? That can be really useful for understanding how your investments will impact your taxes in retirement.
Absolutely. Programs like TurboTax or H&R Block can help you see what to expect tax-wise, especially if you're looking at different income strategies, like drawing from taxable versus tax-deferred accounts.
Yeah, and with all these tools available, it really feels like there's no excuse to stay in the dark about your finances anymore.
Exactly. And there are also financial planning apps out there, like Mint or Personal Capital, that can help you track your spending and investments in one place. It's like having a financial advisor right in your pocket.
Those apps can be super helpful for keeping everything organized. Plus, they can send notifications for when it's time to review your financial goals, or check your account balances.
Yes, and I recommend starting small. Maybe set a goal to review your portfolio and run those projections once a quarter, and then, build on that.
That's a great approach. And if they're looking for resources, what about books or podcasts? Any favorites?
Oh, there are so many. The Boglehead's Guide to Investing is a solid choice for anyone looking to understand investment principles. And for podcasts, I really like The Retirement Answer Man. It's full of practical, actionable advice.
Those are excellent suggestions. I think it helps to have a mix of resources at your fingertips. It keeps you motivated and informed.
Yes, and remember, it's never too late to improve your plan. Just small changes can lead to significant improvements over time.
That's a comforting thought, David. It really is about progress, not perfection.
Exactly. And as people implement these steps, they can also consider their long-term goals. Like, what kind of lifestyle do they want in retirement? That can really shape their investment choices.
Right, and connecting those lifestyle goals with their financial plans makes everything feel more intentional.
So with these tools in your pocket, you're ready to strengthen your retirement plan. Let's recap what we've covered today. Well, Emily, as we wrap up this conversation about growth versus income investing for retirement, I think it's important to highlight a few key takeaways for our listeners.
Absolutely, David. One of the big points we discussed was the balance between growth and income, right? Finding that sweet spot can really make a difference in how folks approach their retirement planning.
Exactly. And remember, it's not just about choosing one over the other. It's about understanding how each can play a role in your overall strategy. Diversification is key.
Right. And then there's the importance of risk tolerance. Everyone's situation is different, and knowing how much risk you're comfortable with can really guide your investment choices.
Yes, and let's not forget the power of staying informed. Regularly reviewing your investments and adjusting as necessary is crucial for maintaining your retirement wealth.
For sure. And having that long-term perspective is vital. It's not just about today or tomorrow, but how your investments will serve you over the years.
Well said, Emily. Building and protecting your retirement wealth is a journey, and it's all about making informed decisions along the way.
That's a great way to put it, David. And for all our listeners out there, if you found value in today's discussion, please take a moment to like, subscribe, and comment with your biggest takeaway or any questions you might have.
Yes, and don't forget to share this episode with someone who's planning for retirement or already in it. It's always nice to have these conversations with loved ones.
Definitely. And next time, we'll dive into a topic that many of you might be curious about: how to avoid required minimum distribution taxes. So stay tuned for that.
It's going to be another insightful episode.
We can't wait to see you then. Thanks for joining us today.
Take care, everyone.
Bye for now.